Hi, welcome back to week 4. Today we're talking about filing status, dependence, and due diligence. This week we're covering one of the most important areas in tax prep, choosing the correct filing status, identifying dependents, and making sure we follow IRS due diligence rules. This is where refunds and credits are made or lost. By the end of this lesson, you'll know exactly how to determine a client's correct filing status, who qualifies as a dependent, and how to document your work so the IRS doesn't come knocking. These 5 statuses determine standard deduction amounts, eligibility for credits, and tax rates. Choosing the wrong one can literally cost your client thousands of dollars. Single is straightforward, and married filing jointly is common. But married filing jointly is tricky. It's sometimes used for liability protection, but it almost always means paying more taxes. Single, not married, legally separated, or divorced as of December 31st. Married filing jointly, most married couples, usually lowest tax. Married filing separately can protect from spouse's tax issues, but usually higher tax. Head of household is one of the most misused statuses. Clients love it because it usually gives a bigger refund, but it has strict rules. If you can't prove it, the IRS will deny it. Head of household must be unmarried or considered unmarried, must have a qualifying dependent, must pay more than half the cost of keeping up the home. Dependents allow credits like the child tax credit and earned income tax credit, but not everyone who lives in the home qualifies. You must apply the tests carefully. If you're a tax partner and have any questions about this or anything in this lesson or previous lessons, please feel free to ask in our group chat. Dependents are one of the top reasons returns get audited. Don't just take your client's word. Verify, ask questions, and document. As a tax preparer, you are legally required to prove you asked the right questions. That's what Form 8867 is for. If you skip this step, the IRS can fine you, not just the client. Due diligence Form 8867 is required when claiming EITC, Earned Income Tax Credit, Child Tax Credit, AOTC, the Education Credit. Head of household must ask for document and keep proof. The IRS loves paper trails. If you're ever questioned, having documentation can save you from penalties. If it's not documented, it didn't happen. Document, document, document. Keep copies of W-2s, 1099s, proof of residency, birth certificates, school records. Keep all notes for 3 years minimum. Use checklists and client intake forms. This week, I want you to practice. Take a blank 1040, circle where filing status is marked. Review Form 8867 so you know what's required. Then create one sample client and practice choosing filing status and dependents. To my tax partners, start creating fake dummy accounts in the Tax Boss software, and we will be having live classes soon. Please DM me for the schedule. Great job to making it to week 4. You're building a strong foundation, and your clients will depend on you to get these details right. Next week, we'll roll up our sleeves and actually input income types into the tax software. Talk soon. Bye.